Hello, my name is Briant Sikorski. I'm an independent financial planner and wealth advisor with Stratos Wealth Partners. I help my clients with planning services such as financial, retirement income, insurance, or college savings, investment management, including stocks, bonds, mutual funds, exchange traded funds, life, disability, and long term care insurance. And finally, supporting and servicing those clients as they go through different life changes, job changes, promotions, layoffs, births, deaths, marriages, divorces, any of the financial impact that comes about as a result of any of those life events. I do run a webinar like this every single month. When it completed, for those of you that did not attend the live session, I've recorded this and I will upload it to my YouTube channel. And I'll show you at the end of this presentation how to get to that. So today, again, Outlook 2019. We've had 10 years of the U.S. economy and stock market recovering and thrive, and as a result, many investors are starting to wonder if we've seen all of this expansion and bull market have to offer. Despite the market weakness we saw at the end of last year, at LPL Research, we expect the U.S. economy to grow in 2019 and support gains for stocks. However, it's a good time to start thinking about what the next phase of the economy and markets may look like. So first, we'll start off with the economy. We're expecting the economy to grow at a 2.75%. And LPL Research believes that expectations should be lowered a bit in 2019 and forecasts U.S. gross domestic product growth to be 2.5 to 2.75% in 2019. And supporting this are consumer spending, investment, driven by business and government spending. Now, stocks in of themselves should return possibly in the range of 8 to 10% when including dividends, as measured by the S&P 500 index. And these are driven by potential earnings per share gains in the range of 6 to 7%. Based on expectations for economic growth and monetary policy, along with the fiscal tailwinds of government spending, reduced regulation, and lower taxes, LPL Financial Research expects 2019 may be a good year for equity investors. Accordingly, LPL Financial Research forecasts slight above average returns for the S&P 500 index for 2019. However, as you can see at the very bottom here, from a bond perspective, we're expecting flat returns, and this is based primarily on the Federal Reserve's past and continued raising of interest rates. Now, trade will likely continue to make headlines in 2019, and though tariff talks and trade tensions with China remain, progress has been made with South Korea, Japan, Mexico, Europe, and Canada, which supported positive market sentiment in the third quarter of 2018. Moreover, the conclusion of the recent G20 summit in Argentina resulted in sort of a trade truce, whereby the U.S. and China committed to working on a more lasting trade resolution within the next few months. Although tariff threats may seem scary, trade actually represents a small portion of the overall economy, and the fiscal management should more than offset the potential negative impact of tariffs. So the Tax Cut and Jobs Act and its components should offset this potential negative trading impact as a result of tariffs. So even though we expect a resolution, if it takes longer than expected to reach an agreement, then it's possible that continued trade discussions could further weigh on market sentiment. The ongoing uncertainty could have a greater impact, potentially slowing the pace of business spending or the rate at which the fiscal stimulus is implemented. Now, considering the Federal Reserve's or Fed's likely path for interest rates and how that may influence the economy and markets, the onus is on the federal legislatures to support the durability of the current economic expansion. The setting of fiscal policy, whatever the party leadership, is always complicated, and there will always be some policies that raise concerns among market participants. Now, this is kind of interesting here. It shows what historically has occurred from a stock market performance perspective when we've had in a Republican president. And on the left is the average S&P annual returns. And we can see that when we've had a Republican president and a complete Democratic House and Senate, the rate of return, average rate of return on the S&P 500 has been just a little over 8%, maybe 9%. If, on the other hand, it's a Republican president and Republican House and Senate, the S&P index has averaged maybe about 11, a little over 11%. But interesting enough, when we've had a split Congress with the House or the Senate being held by each party, along with a Republican president, ironically, that's been the best performing scenario for the stock market, returning almost an average of 16%. So while estimates may not develop as predicted, fiscal stimulus, which was particularly, again, fiscal from the administration and Congress and the Tax Cut and Jobs Act, and that's as opposed to monetary policy or monetary stimulus that was propagated by the Federal Reserve through lowering of interest rates. The fiscal stimulus of lower taxes, lower corporate taxes, lower individual taxes, less regulation, government investment did its job last year in 2018 with the U.S. economy growing at an average of 3.3% over the first 3 quarters. And this is compared with the expansion average of only 2.3% GDP growth. So while we expect expectations should be lowered a bit in 2019, we continue to expect that the ongoing impact of the fiscal stimulus will become readily apparent. We are looking for GDP growth of 2.5% to 3.75% in 2019, and this is supported by consumer spending, business investment, and government spending. And if you look at these charts on the far right-hand side, we're seeing LPL Research estimate of 2.5% to 2.75%, developed ex-US at only 1.9%, and that in particular includes the European continent. Conversely, emerging markets are looked to grow 4.7%, and they will be the leading catalyst to an overall global increase of 3.7%. And yet we see on the bottom page still a very measured inflation rate and a very low unemployment rate of only 3.6%. So despite economic slowdowns, business spending was very robust in 2018. If this trend persists, it's possible the cycle may elongate even further. Surveys suggest that the business spending may grow at a solid rate of about 7% in the year ahead, such that early signs of a slowdown could prove to be temporary. And this is coming from the Institute for Supply Management's Manufacturing Purchaser Managers Index, which is often used to measure or assess corporate infrastructure, corporate internal spending, corporate investment. So high business confidence should support increases in, in these capital purchases. Now, for those of you that may have heard about the quote flattening yield curve, investors have had sometimes an obsession with the flattening of the U.S. Treasury yield curve, which dominated the headlines many times in 2018. A flattening yield curve occurs when short-term rates are rising faster than long-term rates, where short-term rates are higher than long-term rates. And historically, this has been a negative signal for the U.S. economy, often providing an early warning of an impending recession, which is why the yield curve has been garnering so much attention recently. So while we believe these concerns were a bit overstated given the positive economic environment, we do expect both short and long-term rates to gradually rise in 2019, keeping the yield curve somewhat flat. However, if that continues to occur in the context of solid economic growth and modest inflation, we don't think that a flat yield curve should be read as a signal of rising recession risk. So if you look at this chart, you can see that back in 1990, there was almost maybe an 8% difference in the yield provided by a 10-year, in other words, longer-term Treasury yield, as opposed to in blue here the 2 to 10-year Treasury yields. So historically, long-term maturing bonds have paid a higher rate of interest. But we can see in the last 10 years that has not always been the case. The yield on the benchmark 10-year U.S. Treasury jumped roughly 0.6% in 2018. This was as of the end of November, and it rose from 2.4% to 3%. Now, market interest rates moved higher as economic growth gained traction, and inflation measures approached the Fed's target for price stability. Remember, the Federal Reserve has as its objective to moderate inflation versus unemployment. In addition, the rising federal budget deficit caused Treasury auction bidders to demand higher yields for the risk they were taking on, particularly since the Fed, with the end of quantitative easing, or QE, was no longer backstopping the U.S. Treasury market. The current bull market is officially the longest in history, and the economic expansion is quickly approaching that milestone as well. It'll be the longest expansion ever as of May of this year, 2019. So what does age have to do with it? Well, considering that on average, the typical bull market and expansion last approximately about 5 years, reaching the 10-year mark is quite a feat. For those who are concerned that the cycle may have gone on too long, there is some interesting context to consider. Assuming that the start of the current bull market began after the lows achieved in March of 2009, then it's the longest in duration, but in magnitude. So we've had other expansions that have been higher. We can see that in March of 91 versus June of 2009. We can just see that there's been close, but again, a longer expansion, but not a higher in magnitude. Now this shows us the return from U.S. stocked, developed international stocks like Europe, and emerging markets, small, particularly those in small countries. So you can see that we favor emerging markets over developed international equities for their solid economic growth trajectory. very favorable demographics, attractive valuations, meaning their prices are lower and considered a good buy, and prospects for a U.S. trade agreement with China with a bias towards emerging Asia. Growth in Europe has been slowing and may struggle to reach even 2% in 2019, while the growth in Japan is also lagging despite stimulus and corporate reform efforts. So GDP growth in China and broader emerging markets is likely to more than double the pace of developed international economies in 2019, and we believe political uncertainty is actually higher in Europe than it is in these emerging markets. Now note that this chart is dated as of November 30th of last year. So here's the toy in the Cracker Jacks box, I guess. And this is what we want to know. Okay, that's all great and well, but what does that mean in how we go about investing? Well, LPL Research has categorized this into three different columns. Number one, new and noteworthy, which is kind of the buy. Number two is classics. So these are investments that we don't want to count out. They are sometimes relatively timeless and could be a solid core to your portfolio. And three, those considered out of print. They might have to wait for the next edition. These investments aren't gaining much traction. So in the new and noteworthy category, what do we see? So number one, U.S. stocks. With superior economic and profit growth and the fiscal stimulus, these provide an edge over developed international stocks. Two is economic growth, tailwind, and attractive relative valuations compared with growth may help buoy value stocks. So value stocks are those that are considered to be underpriced of maybe either competitors or their sector or maybe for some other reason. Cyclical stocks, and cyclical stocks are those that individuals will influence through their buying power. If the economy and job is good, they'll spend more on consumer cyclicals like cars and motorcycles. And if the economy is not as good or the job is not as secure, they'll spend less. Emerging markets with strong growth, attractive valuations, and potential U.S. trade agreement may help emerging market equities outperform. For those of you that need income to supplement maybe your portfolio, we're recommending investment-grade corporates where economic growth may help credit-sensitive bonds, and added credit risk provides an incremental yield. And mortgage-backed securities where the yield benefit relative to rate risk remains attractive among high-quality options. Now, if we look at our classics, those are